Hey, what's up, guys? So, today I wanted to talk about an interesting topic. Started learning about this primarily in college when I started seeing stocks react very heavily to earnings, and that's the earnings and guidance surprise. So, in the last video, I talked a little bit about how to prepare for earnings season, and obviously, earnings season is somewhat of a busy time for many investors, especially dividend investors, when you have to basically go over the earnings reports, conference calls, and so forth for all of your holdings. And one of the things that's very important in terms of what can happen to your stock is the earnings surprise. So, a lot of, for many large cap stocks, there will be a lot of analysts on Wall Street who estimate, revenues and profits for the current quarter. So if you go to Yahoo Finance or basically any other finance website, you can check and see what the analysts are expecting. So, for the June quarter for Apple, there are 35 analysts covering the stock, and they're expecting an average earnings estimate of $2.10 and revenue of about 53.42 billion. So that's what they're expecting. Now, the surprise is basically what Apple actually reported relative to expectations. So they're projecting $2.10 of profit. So if Apple reported $2.15 of profit, that would be what would be called a positive earnings surprise, meaning they beat expectations. Now if they reported $2.05, that would be called a negative earnings surprise because they reported results below expectations. And the reason why this is important is because stocks can react very violently to earnings expectations. And it's just not earnings expectations as well, it's also guidance. So a lot of companies provide guidance of some kind, typically for revenue or profits or some other metric that is really important for the company, some kind of key performance indicator, KPI. A lot of companies provide either quarterly and or annual guidance, but not all companies provide guidance. It's kind of a hot topic today, but I don't want to get too deep into that. So that's basically what the earnings surprise or the guidance surprise is, and it can have a really big impact on your stocks even in the short term. So, negative earnings surprises can definitely rock a stock 5 or 10% in the course of a day, depending on what happened. And as a dividend investor, short-term movements in stocks really aren't that consequential if you look in the long term. But it does provide a lot of volatility in terms of the short term, and you can take advantage of that volatility if, say, the stock fall, but nothing really happened in terms of the long-term prospects of the stock. And in terms of short-term volatility actually makes option prices more expensive. So if you're executing a covered call strategy in conjunction with your dividend investing strategy, that can actually help you out there, because when you're selling the call options, you'll actually make more money because of the increased volatility. So anyways, that's just a quick tutorial or explanation of what an earnings surprise is and how that actually affects dividend investors.